Well, gold has everything going for it right now in principle. Why? Well, we see growth expectations are coming off for the U.S. in particular, the Fed becoming more hesitant to raise interest rates. St. Louis Fed President Bullard made a comment very recently to that effect, that he's now concerned that maybe it would be dangerous to continue raising interest rates in the current weak growth environment. And the Atlanta Fed's GDP measure is pointing to a current rate of GDP growth very, very close to zero. I mean, this does not look like it's the sort of environment where interest rates are going up. And other factors equal, because gold, of course, does not pay an interest rate. If it's perceived that dollar interest rates are not going to be rising, other factors equal, that favors gold. And if you combine that with what is still a somewhat risk-averse environment globally, you can make a very bullish case for gold here, extending the recent strong move to the upside. Well, obviously, if data starts to move back in the other direction, if it looks like, no, wait a minute, in fact, the U.S. economy is a bit more resilient than we thought. If some of the other economies in the world that have been struggling, such as Brazil to some extent, say, and China slowing down, if the data starts to turn the other way, then that will go against gold in principle. But that said, let's face it, where is a lot of the growth coming from? A lot of it's coming from government spending in both developed and emerging economies, and a lot of it is coming from past monetary stimulus still rolling through the system. If your growth is really only coming from artificial stimulus, physical or monetary, that doesn't lead to self-sustaining growth, and it's self-sustaining growth that's truly potentially negative for gold, not artificial growth. I think gold has every reason to find its way back into a very significant secular multi-year bull market. Look at the amount of debt in the world. Look at the growing money stock in the world. Look at the scale of the imbalances, such as accumulated trade deficits and surpluses, and place that in its historical context. And if you look at history, it suggests that, in fact, the price of gold on a multi-year view could be an order of magnitude higher than it is today. Gold plays an essential role in a portfolio, if only as a kind of insurance policy against those unusual but very harsh investment climates in which financial assets in general do poorly. Sometimes both stocks and bonds do very poorly. That's when you want to have some gold. And I've done some studies on this, and in fact, if you look back through many decades, you can make a very persuasive case that almost a neutral position in a portfolio, one where you don't have a strong view on gold, but just want to diversify, you should have around 10 to 15% of a portfolio in gold. That's a much larger allocation than most investors would normally think was sensible. They would think maybe 2 to 3%. It should be much higher than that if you look at history carefully.